Every hour of every day, the United States creates new money inside secure buildings and inside powerful banking systems. Not only through printing presses, but also through banks that create digital dollars inside powerful computer systems every day. More than $500 million in physical cash rolls off these machines every single day across the country. But compared to the digital money created by banks, that physical cash is only a small, visible fraction of the total supply. Today, over 90% of US money exists only as digital numbers inside bank systems across the country. And every single day, banks add billions of new dollars into that system through loans issued to people and businesses. No trucks move this money across the country, and no armored vault stores the vast majority of it in any physical location. Instead, it exists only as electronic records stored inside vast banking networks and modern digital payment systems. Those digital numbers fund home sales, small businesses, public programs, and almost every large deal across the entire economy. As more of these dollars enter the system, they push prices higher and steadily expand total household and national debt levels. To see how this system truly began, we have to go back to a time long before dollars even existed. Long before banks and digital systems, people traded real goods directly with each other in small local markets. If a farmer needed a tool, he gave his word to repay the maker later, with food from his next full harvest season. That promise had real value, because trust held small groups together and it allowed people to trade safely with each other. In the beginning, money was nothing more than trust between people, built slowly through repeated promises and shared belief. A farmer once paid for tools, not with coins, but with a written promise to deliver crops after the next full harvest. He agreed to bring food later in exchange for the tool he needed that day, once the full harvest season was complete. That promise carried real value, because both men trusted it would be honored when the proper time finally came. Over time, trade shifted toward common goods that many people agreed carried stable value within growing local communities. Items like grain, salt, and cattle became widely accepted forms of payment in many early agricultural trading societies. These goods were useful and trusted, but they were hard to move, risky to store, and inefficient for growing trade across regions. Then societies turned to gold and silver, metals that were rare, durable, and easy to carry across long distances. Gold and silver were durable, portable, and scarce, which made them ideal for expanding trade between distant regions. Coins made trade faster and safer, allowing merchants to exchange value across borders with greater confidence and consistency. But carrying large amounts of gold created new risks, especially from theft, loss, and violent attack during long journeys. It was heavy, difficult to protect, and dangerous to move across long distances through unstable political regions. In 17th century London, goldsmiths began offering secure storage for gold and silver inside heavily guarded vaults. In return, they issued paper receipts that represented a formal claim on the gold stored safely inside their vault system. Anyone holding that receipt could later redeem it and receive the exact same amount of gold from the secured vault location. Soon, those paper receipts began to circulate widely, replacing heavy metal coins in everyday trade and commercial exchange. Then a critical shift happened, when goldsmiths realized that most of the gold stored in their vaults was never withdrawn. They realized that most customers left their gold inside the vault for extended periods of time without requesting full withdrawal. So they began issuing more paper receipts than the actual gold they physically held inside the secure vault system. By doing this, they created financial claims on gold that did not actually exist in physical form inside the vault system. As long as people trusted the system and did not all demand their gold at once, the entire structure remained stable. That same logic still defines the foundation of modern banking systems around the world today, including the United States. Today, banks no longer issue paper backed by gold. They create digital deposits inside modern financial systems. When you place money inside a bank account, it legally becomes a liability recorded on the bank's financial balance system. Your account balance is not stored cash. It is simply the bank's formal promise to repay you on full demand. Now, here is the critical mechanism that changes everything inside modern banking and explains exactly how new money is created. When a bank approves a loan, it does not move money from another account. It creates a new digital deposit inside the banking system. Instead, the bank creates brand new money by typing digital numbers directly into your personal account balance. Those digital numbers did not exist before the loan was approved, recorded, and officially entered into the banking system. At that exact moment, both the new money and the matching debt obligation are created together inside the financial system. Debt and money are created together, expanding the total money supply inside the wider national economic system. At that moment, the total money supply increases instantly inside the broader national financial system and credit structure. When you repay the principal on that loan, the created money gradually disappears from the broader financial system entirely. The principal amount is permanently deleted from the system and removed from the total money supply calculation process. Only the interest portion remains inside the banking system, becoming steady income for the lending financial institution. This means most money exists in the modern economy because someone, somewhere, currently owes that amount back to a financial institution. This steady growth in credit is what fuels business activity, home purchases, and broader economic growth across the country. You borrow money to purchase a car using newly created credit that did not exist before that formal loan agreement was signed. The dealership then pays its employees, transferring that newly created money into formal payroll accounts across the company. Those employees then spend that income at local stores, pushing that same credit further through everyday business activity across the country. One single loan can multiply through many transactions, steadily expanding economic activity across the wider national economy. Without steady credit growth, the economy slows, businesses cut back, and production starts to fall across the country. But credit can also expand faster than the real economy produces goods and services for people and businesses. When that happens, more money chases the same goods, and prices begin to rise steadily across the broader economy. Inflation is not random. It is the gradual dilution of currency value caused by expanding credit within the financial system. And over time, that dilution steadily reduces the purchasing power of every dollar currently circulating within the broader economy. Commercial banks do not operate alone. They function within a larger national financial system, controlled at the central level. In the United States, that central authority is the Federal Reserve, which sets interest rates and guides the nation's money supply. The Federal Reserve creates digital reserves that commercial banks use to settle payments and support lending activity. By adjusting these reserves, the Fed directly influences how much banks are able and willing to lend into the broader economy. The Federal Reserve also interacts closely with government debt, especially through the issuance of treasury bonds and securities. When the US government spends more money than it collects in taxes, it issues new treasury bonds to cover that shortfall. These treasury bonds are formal promises to repay investors with interest over a defined period of time under legal contract. Banks, pension funds, and foreign investors purchase these bonds, sending existing money directly to the federal government budget. The government then spends that money into the economy, paying companies, contractors, and major public infrastructure programs. If private demand weakens, the Federal Reserve can step in and purchase those treasury bonds directly in the open market. It pays for those bonds using newly created digital reserves, expanding the central bank balance sheet and total liquidity. Through this process, government debt becomes a powerful mechanism that injects new money directly into the broader financial system. Taxation removes money from the system, pulling digital deposits out of circulation and reducing overall liquidity. Debt does not destroy money. It shifts purchasing power forward across time into structured future repayment obligations. If borrowing suddenly stops, credit contracts sharply, and economic growth begins to reverse across the broader economy. If trust in the financial system breaks, instability spreads rapidly through markets, banks, and broader public confidence. Modern money today is not backed by physical gold, but by institutional trust and the government's legal authority to tax. It is sustained by public confidence, supported by taxation authority, and recorded across the balance sheets of commercial banks. Money is not simply printed into existence. It is created on balance sheets through structured lending and recorded debt.